The Zacks Rank, value, momentum, growth, and income all factor into Zacks Rank buys.
Our value strategist, Tracey Ryniec, scours the market daily for value stocks that she wants to bring to your attention. And this time around is not any exception. You did manage to find a couple more.
I did.
Even though the pickings might be slim out there these days.
They still are, yeah. Even with this slight market weakness here, it's still kind of rough to be a value investor.
Well, one is D.R. Horton, home builder.
Yes, that area has been really hot this year. Anyone who's been trying to buy a house, has been frustrated, probably even existing home or the new homes. The housing market is back. It's been back for a couple of years, but this year is especially strong. The mortgage rates have remained low, right around 4%, so that's really helped them. These guys just had a great quarter, a great third quarter. They posted closings up 37%. Their backlog was up 12%. These are things you want to see with the home builder. You want to see that backlog increasing, because that means in future quarters when those actually go to close, the sales are in there and you're going to have an increase in sales. Yeah. So everything is going good for them. I mean, they're nationwide, so they're kind of the epitome of the whole entire housing market. The estimates are all rising. Analysts like what they see here. Like I said, it's a strong housing market. They're also across all of the levels of housing. So they build as cheaply as 100,000 up to $1 million. So they also are able to kind of target what's hot and what's not. The little bit more luxury is hotter right now, so I'm sure they're probably moving a little bit more in that direction. But you can see the chart's pretty choppy for basically all the home builders. This one isn't quite as bad. It is, shares have been rising if you've been able to be patient and ride out kind of these waves. It's trading at about 14.5 times, so that's cheaper than the overall market. And overall, a lot of the home builders are fairly cheap right now. Whether or not they're really going to get a fire lit under them, I don't know. I think people are kind of on the sidelines, even though the numbers and the fundamentals are good, because of what the Fed may do. If they start raising the interest rates, that will push the mortgage rates up probably. And that could put a little damper on the housing market. So that's something to watch. But otherwise, I kind of like the home builders.
All right, well, this other company is a bank, Citigroup.
I know.
Talk about watching what rates are going to do.
Well, yeah, they're kind of in the same space. But these Citigroup, super mega large cap bank, worldwide operations, very diversified. They're not just loans. I mean, they have investment banking, they're in fixed income, all of these things. So they got a lot of wheels churning at the same time. They have stabilized after, the crisis. They've been kind of just treading water, doing their thing the last couple of years, and the analysts really like kind of where they sit right here. They're stable. There's nothing, the credit quality is good. Nothing is going crazy, but there are a few things that are happening right now. The Fed may raise that should help the banks. But then we also have this devaluing of the yuan by the Chinese, which could also have an impact on these big global banks as well. But you can see the estimates rising here. It's a Zacks number 2. And, it's got some good earnings growth this year. And even next year, we're still seeing the rise. So the estimates are all looking good for the banks. And you can see that it's starting to translate in what the shares are doing. It's at a 1-year high or near one now. And you're starting to see these really off the lows of a couple of years ago. And the banking sector in general, the big banks and especially the regional banks, which will get a boost from that the Fed if they start to raise, are pretty good buys here. And a lot of them are value. So Citigroup trading around 10 times. Its price to book is under 1, and its peers are about 1.3. So both of those metrics for a bank are low.
And its dividend is almost non-existent.
Well, right. I mean, back in the day, if you remember, almost everybody used to buy the banks for the dividends because they have historically paid out huge chunks of what they make, and you used to get great yields, 4, 5, 6%, even back in the day. And those were all obviously cut during the crisis and haven't really come back. They pay like a 0.3% yield right now. So they are paying out something, but you're clearly now not buying Citigroup for the dividend. You're buying it for this earnings growth. And you know, we'll see what the future holds, but things are looking better for these big U.S. banks.
Dividends still might be a little bit more than what they pay in passbook savings these days.
That's true. That might be still, yeah. Or at least you might break about the same.
Yeah, that's right. Do you own either of these two?
I do not.
All right, check out more stocks and stock picking strategies, stock commentary, and other interesting information on our website, Zacks.com. Link to it all off the homepage if you're not there already. And if you're watching these videos on YouTube's platform, don't forget you can always subscribe to them and even comment on them. With Tracey, I'm Terry Ruffalo.